Welcome back to the deep dive. Today we're going to be tackling the world of trading system development.
Oh, very cool.
And we've got some pretty interesting material to work with.
Okay.
Lecture transcripts from a seasoned trading instructor.
Nice.
It's like a crash course in what not to do
Oh, interesting.
when you're building your own trading system.
I like it.
Yeah, so think of it as a roadmap of mistakes to avoid.
Okay, yeah, and these aren't just any lectures, right?
Yeah.
These transcripts capture almost 2 years of his observations of
Wow.
watching his students make the same mistakes over and over again.
Oh, that's got to be frustrating.
Yeah, it's like having a front row seat to the most common pitfalls
Oh,
in
fascinating.
system development.
Yeah, so we're really going to be able to get into the nitty gritty.
Yeah, and to make things even more interesting,
Okay.
the instructor has added 2 M's
Oh,
to the traditional 7 M's of system development.
really?
Mistakes and mastery.
Okay, I like that.
Yeah, he's not just giving us the building blocks, right? He's showing us how to avoid the potholes
I love that analogy.
on the road to success.
All right, so let's dive into the first strategy mistakes.
Right.
And, one thing that the instructor really hammered home
Mm-hmm.
was the importance of reading and research.
Of course. Yeah.
He even shared this anecdote about how he takes photos
Really?
of interesting passages from trading books and articles
Interesting.
to build his own, swipe file of ideas.
Oh, I love that.
Isn't that cool?
It reminds me of how artists and designers collect inspiration.
Yeah.
You're essentially curating a library of trading concepts
Right.
to spark your own creativity.
Exactly. And speaking of creativity,
Okay.
the instructor had this really interesting take on originality.
Oh, okay.
He actually cautioned against
Against.
trying to pull a strategy out of thin air,
Interesting.
especially for, beginners.
Yeah, makes sense.
Yeah, he's not saying don't be original.
Right.
He's saying stand on the shoulders of giants, right?
Okay.
Learn from the masters,
Mm-hmm.
understand what's worked before,
Yeah.
and then find ways to adapt and improve.
Adapt and improve. I like it.
He even gave us a simple but powerful mantra.
Okay.
Read more, search, steal, and modify.
Ooh, steal and modify. I like that.
Yeah, right.
All right, so we're gathering inspiration. We're reading.
Yeah.
What's next?
Well, once you've got that inspiration,
Right.
it's easy to get lost in the world of indicators and code.
Oh, yeah, for sure.
But the instructor had a great point about not letting indicators overshadow
Mm-hmm.
your core trading idea.
Right. It's like the why behind your strategy,
Yeah.
not just the technical how.
Yeah.
It's kind of like cooking, Yeah. You can have all the fancy ingredients and equipment,
Right.
but if you don't have a clear recipe in mind,
Yeah.
you're just going to end up with a mess.
That's a perfect analogy.
All right, so we need that recipe. We need that why.
Yeah, and speaking of clear recipes,
Okay.
the instructor introduced this really handy checklist.
Oh, nice.
He calls it the VIP conditions.
EIP, okay.
Volume,
Got it.
indicator,
Okay.
and price.
Okay.
It's a simple way to make sure your strategy draft
Right.
considers the interplay of these critical elements.
I think this is so valuable, especially for beginners.
Yeah,
It forces you to think about how volume might confirm a breakout
right.
or how price action near support levels
Yeah.
might strengthen an indicator signal. It's a reminder that these factors work together,
They do.
not in isolation.
Absolutely. And while we're on the topic of keeping things simple,
Okay.
the instructor's a big advocate for straightforward algorithms.
Yeah.
He actually said that he dislikes strategies
Uh-oh.
that switch between two different approaches
Interesting.
within a single trading file.
He has a point, though.
Right.
When your algorithms are easy to understand,
Yeah,
it's easier to identify weaknesses, make improvements,
absolutely.
and adapt to changing market conditions.
Yeah.
Plus, it makes things less overwhelming for you,
Oh, for sure.
the trader. Imagine trying to debug code that's
Yeah.
constantly shifting gears.
Yeah.
Talk about a headache.
Oh, my gosh.
So keep it simple.
Now, another concept that the instructor emphasized
Okay.
was the idea of a position score.
Position score.
And this is essentially a way to prioritize
Okay.
which trading signals to act on,
Right.
especially when you can't buy every stock.
Right. You can't chase every opportunity.
Yeah, exactly.
So how do we do that?
Well, he challenged us to rigorously test our position score
Okay.
against a random selection of stocks.
Against random? Okay.
Yeah, and get this.
What?
He doesn't even expect you to crush random selection.
Really?
Aim for a small improvement,
Right.
like 2 to 5%
Over random.
over random.
Okay.
That's how you know your system is actually working.
So it's about demonstrating a consistent edge,
Yeah.
even a slight one, over pure chance.
Exactly.
That's how you build confidence in your system.
Okay, so we've talked about strategy. Let's move on to the next. M,
Right.
data mistakes.
Data mistakes.
And the instructor shared a personal anecdote
Okay.
about how he learned the hard way.
Oh.
That backtesting data
Yeah.
can be very misleading.
Okay.
He even uses multiple financial data sources
Really?
to double-check his work,
Wow.
especially when dealing with things like stock splits.
So he's really thorough.
Yeah. And he had this great point about survivorship bias,
Survivorship bias.
something I think a lot of us overlook.
Okay.
Imagine you're backtesting a strategy
Mm-hmm.
on a stock database,
Okay.
but that database only includes companies that are still around today.
Right.
The companies that went bankrupt or got delisted.
Yeah.
Gone.
So your backtest might look amazing,
Right.
but it's only showing you the survivors.
It's
It's not the full picture.
That's survivorship bias.
Okay.
And it can really skew your results
Wow. So have you ever run a backtest
Oh, really?
and thought this seems too good to be true?
all the time.
Well, survivorship bias could be the culprit.
It very well could be.
It's a hidden danger
Yeah,
that can lead to overly optimistic backtests.
absolutely. So this raises an important question for you, the listener.
Oh, yes.
Where are you getting your trading data?
Right.
And how can you verify its completeness?
That's a good question.
Now, the instructor also challenged the assumption
Okay.
that using all available data for backtesting
Mm-hmm.
is always the best approach.
Really?
He really stressed the need to reserve some data
For out of sample testing.
out of sample testing.
Think of it like studying for a test,
Okay,
using the exact same questions that will be on the exam.
got it.
You might ace the test,
Right.
but it doesn't mean you truly understand the material.
Okay.
Out of sample testing is like taking a different version of the exam.
Ah, I see.
It helps you validate your strategy
Right.
on data it hasn't seen before.
It hasn't been trained on.
Exactly. And finally, to ensure your strategy can handle
Yeah.
different market conditions.
The instructor recommends using historical data.
Okay.
That includes both bull and bear markets.
Makes sense.
That way, you're not just optimizing for good times.
Right.
Your system is prepared for the inevitable downturns.
Gotta be prepared for those downturns.
Yeah. So we've talked about strategy mistakes.
Yes.
We've talked about data mistakes.
Data mistakes.
Now let's move on to the third,
Yeah.
backtest mistakes.
Backtest mistakes.
And the instructor had this funny anecdote
Oh, I love his anecdotes.
about students using the same initial equity
Okay.
in their backtests and live trading.
Oh, wow.
And he even asked them,
What'd he say?
is that your entire trading capital or just for paper trading?
Oh, my gosh.
It really highlighted how using an unrealistic initial equity
Right.
in your backtests can distort your results.
It's like testing a race car
Yes.
on a perfectly smooth track
Yeah.
and then expecting it to perform the same way on a bumpy road.
Exactly. If you're testing with $1 million,
Right.
but only have 10,000 to trade live,
Yeah.
your risk tolerance and position sizing
Totally different.
are going to be completely different.
It's all about aligning your testing environment
Yes.
with your real-world constraints.
The instructor also stressed the importance of understanding the backtester settings
Oh, yeah.
in your trading software,
Yeah.
especially those related to stop losses and trade execution.
Every platform has its quirks.
It does.
Don't assume your settings
Right.
perfectly mirror real-world trading.
Yeah.
You need to understand how those settings translate into
Right.
actual trades,
Right.
especially when it comes to things like slippage
Yes.
and order execution speed.
Otherwise, you might be unpleasantly surprised when your live trading results
Right.
don't match your backtest.
Exactly. And, just because a simple backtest looks great,
Yeah.
don't blindly trust the results.
Okay.
The instructor recommends incorporating simulations into your backtesting process to gain more confidence in your strategy's performance.
So simulations help you account for
The randomness
the randomness.
and variability inherent in the market.
Exactly. And finally,
Okay.
don't just focus on the best case scenarios
Right.
in your backtests.
Mm-hmm.
Analyze confidence levels for key metrics
Yeah.
like returns and drawdowns
Okay.
to get a more realistic picture of how your strategy might perform.
It's about understanding the range of potential outcomes.
Yes.
Not just the most optimistic one.
And even though the instructor admitted
Yeah.
that he prefers focusing on backtest reports
Okay.
rather than charts,
Uh-huh.
he stressed the value of visually analyzing stock charts.
Charts can reveal patterns and insights that might not be obvious from the numbers alone.
They provide context.
They do.
They can help you see how your strategy plays out in different market environments and identify potential red flags.
Okay, so we've covered backtesting mistakes.
We have.
What's next?
All right, let's move on to the fourth.
Right.
Market analysis mistakes.
Market analysis mistakes.
And the instructor seemed a bit frustrated.
Oh, no.
That some students didn't take advantage of the market analysis techniques he taught.
So they missed out on the chance to reduce risk. And potentially enhance returns.
He's a strong believer in leveraging market analysis to improve trading decisions.
He makes a good point.
He recommends starting with a simple market filter. Using an index like the S&P 500.
Right.
To identify favorable and unfavorable market conditions.
Makes sense.
It's about being selective.
Yeah.
Why trade when the odds are stacked against you?
Exactly. It's like checking the weather before you go for a run.
Right.
You want to make sure the conditions are right.
And he even suggested visualizing market conditions. Using ribbon charts.
Ribbon charts.
To see those favorable and unfavorable periods.
Interesting.
More clear.
Visualizations can be incredibly powerful. They can help you identify patterns and trends.
Yes.
That might be difficult to see in raw data.
Absolutely. And he had one more important piece of advice.
What's that?
When it comes to market analysis,
don't
rush into complex market-based strategies. He'd really emphasize gaining experience with simple market filters and classifications. Before moving on to more advanced techniques.
Master the fundamentals.
It's about mastering the fundamentals before you try to get fancy.
I like it.
It takes time and practice.
It does.
To develop a feel for market analysis.
Okay, so market analysis, another critical
Absolutely. Now let's talk about the fifth one. Money management mistakes.
Money management mistakes.
And the instructor shared a story about students. Who planned to use advanced money management techniques. Without actually knowing how to code them.
Oh, no.
And he attributes this to a lack of coding skills.
Oh, that's a problem.
It highlights the importance of practical skills.
It does.
You need to be able to implement your ideas.
Right.
Not just conceptualize them.
Exactly.
His takeaway. Stick to money management methods. That you can code and backtest.
Makes sense.
To ensure they actually work for you.
So don't get too fancy.
And he even suggested a general rule of thumb. Keep your position sizes below 10% of your equity
10%.
to manage risk effectively. That's a solid risk management principle that can help you protect your capital.
Right.
Especially during volatile market conditions.
And finally, remember to factor in the business costs.
Oh, yeah.
Associated with trading, data fees, software subscriptions, and so on.
All that stuff.
When determining your initial capital and profit targets.
It's easy to focus on the potential profits.
Right.
But ignoring the costs can significantly impact your bottom line.
Absolutely.
So there you have it, a deep dive.
Wow.
Into the first 5 M's of trading system development.
The first 5.
Covering strategy, data, backtesting, market analysis, and money management.
Very thorough.
We've uncovered some really interesting insights.
We have.
Into the common mistakes that can trip you up along the way.
And it's not just about avoiding these mistakes.
Right.
It's about understanding why they're mistakes.
Exactly.
And how to approach these aspects of system development with a more critical and discerning eye.
What stands out to you from this first part of our deep dive?
That's a good question.
What's resonating with you?
As
you think about your own trading system development journey?
You know, for me, it's the instructor's emphasis on simplicity, practicality. Don't get seduced by complexity. Start with a solid foundation, understand your tools, and focus on methods you can actually implement and test.
Absolutely. I completely agree with you on that. The instructor's focus on the practical side of things is really refreshing. So much trading advice out there is very theoretical, but he brings it down to earth, and makes it actionable. Okay, before we get too carried away, let's move on to the second half of our deep dive. You mentioned earlier that the instructor added 2 extra M's to the classic 7.
I love this edition.
Mistakes and mastery.
Because it acknowledges that mistakes are inevitable.
Right.
But they're also opportunities for learning and growth.
He doesn't shy away from the fact that we're all going to make mistakes.
Right.
It's part of the process.
Exactly.
But he's giving us the tools to identify and learn from them.
And the concept of mastery.
Yes.
That's where things get really interesting.
Okay.
He describes M9 mastery as a journey from novice to expert to well-master.
Wow.
It's about understanding that achieving trading proficiency is an ongoing process.
So it's not just about building a system. It's about constantly refining your skills.
Yes.
Your mindset and your approach.
Precisely. It's a holistic view of trading success.
Okay.
It's about becoming a better trader, not just having a better system.
One of the biggest takeaways for me was how much emphasis the instructor placed on data quality.
Oh.
He even said that every strategy back-tested with bad data is worthless.
Worthless, wow.
It's like building a house on a foundation of sand.
Ooh, I like that.
No matter how impressive the structure looks, it's eventually going to crumble.
That analogy is perfect. You can have the most brilliant trading idea in the world, but if you're testing it with flawed data, your results are going to be meaningless.
And that leads perfectly into another key point.
Okay.
Not blindly trusting backtest results.
Yeah.
Even simple ones.
Right.
It's like he's saying, don't be fooled by appearances.
Okay.
Dig deeper.
He's advocating for a more skeptical and rigorous approach to backtesting. Don't just look for positive results.
Right.
Understand why those results occurred and whether they're truly representative of your system's potential.
He really challenged me to think more critically about my backtesting process. I had a bit of an aha moment when he talked about confidence levels.
Confidence levels.
I realized I'd been so focused on the potential upside that I hadn't really considered the potential downside.
Right. It's human nature to be drawn to positive outcomes.
It is.
But understanding the full range of possibilities, both good and bad, is essential for making informed trading decisions.
Absolutely.
Confidence levels give you a more realistic view of how your system might perform in different market conditions.
Now, we talked about market analysis earlier, but the instructor's point about using market trends to your advantage really resonated with me.
Okay.
It's about recognizing that the market is dynamic.
It is.
And your trading approach needs to adapt accordingly.
So it's about incorporating broader market context into your decision-making process.
Exactly.
Instead of just relying on signals from your system.
Right.
You're looking at the bigger picture.
And he even suggested visualizing market conditions.
Oh, right.
Using ribbon charts again.
Yeah.
To get a clearer view of those favorable and unfavorable periods.
Visualizations can be so powerful.
They can.
They can help you see patterns and trends.
Yes.
That might be difficult to spot in raw data.
Okay, let's talk about money management.
Right.
I have to admit, I was a little taken aback by the instructor's story about those traders who plan to use advanced money management techniques without even knowing how to code them.
Yeah, that story really highlights the importance of practical skills.
It does.
It's great to have ambitious ideas, but you need to be able to execute them.
Yeah.
If you can't translate your money management approach into code, you're essentially just guessing.
His advice to stick with methods you can code and backtest is a good reality check. It's easy to get lost in complex theories.
Yeah.
But ultimately, you need a system you can actually implement.
And speaking of keeping things practical, remember his emphasis on risk management.
Right.
Particularly his recommendation to keep position sizes below 10% of equity.
10%?
Yeah, that's a valuable guideline.
It is.
For protecting your capital, especially during those volatile market swings.
He even cautioned against getting caught up in the hype.
Oh,
about the one-size-fits-all approach to money management.
Right.
What works for one trader might not work for another.
It's about finding what works best for your individual trading style, your risk tolerance, and the specific market conditions you're trading in.
And his point about thinking in terms of risk first, rather than return first, was a real game changer for me.
Interesting.
It's a subtle shift in mindset, but it makes a huge difference.
It's about recognizing that protecting your capital
is
the key to long-term success in trading. If you blow up your account chasing returns, it doesn't matter how brilliant your system is.
He shared a story about a friend who thought trading had suddenly become easy because the market was in a favorable period.
Oh, Oh, no.
That story really illustrated the dangers of chasing returns.
Right.
Without considering the risks.
It's a classic example of how market conditions can influence our perception of risk.
Absolutely.
When things are going well, it's easy to become complacent and overconfident.
That's why the instructor stresses the importance of quantifying your risk, understanding your risk tolerance, and implementing stop-loss orders to limit potential losses.
Absolutely. And he even suggested this really interesting technique for managing risk.
What's that?
If you get stopped out of a trade, avoid re-entering that same trade for a set period, like 40 days.
4 days.
He called it stop bleeding.
Stop bleeding.
Yeah, it's like giving yourself a timeout.
Like that.
To cool off and reassess the situation before jumping back in.
And he also recommended keeping a blacklist.
Oh, a blacklist.
Top stocks that have triggered stop-loss orders to help you avoid repeating the same mistakes.
So it's like saying, okay, this stock has burned me before.
Right.
I'm going to steer clear for a while.
Exactly. Okay, so we've covered a lot of ground here.
We have.
From data quality and back testing to market analysis and risk management.
A lot of good stuff.
And we've delved into his concepts of mistakes and mastery.
Right.
Recognizing that mistakes are part of the journey.
Yeah.
And that achieving trading proficiency is an ongoing process.
He's given us a lot to think about.
He has.
Both in terms of the technical aspects of building a trading system.
Right.
And the psychological aspects of becoming a successful trader.
Absolutely.
Yeah.
What's standing out to you from all this information?
That's a good question.
What are your big takeaways?
You know, for me, one of the most impactful concepts is the idea of constantly questioning your assumptions.
Questioning your assumptions.
Whether it's the quality of your data, the reliability of your backtest,
right,
or your own risk tolerance.
Yeah.
The instructor encourages us to be skeptical.
Be skeptical.
And to validate our beliefs with evidence.
Yeah, I think that's such an important point, questioning your assumptions. It's so easy to get caught up in our own biases and beliefs, especially when it comes to something as emotionally charged as trading.
Oh, absolutely. He actually touched on that directly when he talked about risk tolerance.
Okay.
He pointed out that most people tend to overestimate their risk tolerance.
Oh, yeah.
Which can lead to taking on more risk than they can handle.
Right.
He even suggested this clever trick, divide your perceived risk tolerance in half.
Really?
Get a more realistic assessment.
It's like he's saying, don't just think about how much you want to risk.
Right.
Think about how much you can actually handle losing.
Exactly. And he gave some really practical advice for figuring out your true risk tolerance, like calculating it based on your maximum acceptable dollar loss. Okay. Rather than a percentage.
Interesting.
Then factor in your income and expenses to determine a realistic initial capital amount.
So it's about grounding your trading plan in your financial reality.
Exactly.
Not just some theoretical ideal.
And he even went a step further and said to consider the business side of trading.
Oh, yeah.
Things like data fees, software costs.
Right.
And even your living expenses if you're aiming to trade full time.
It's not just about making money in the market.
Right.
It's about making a sustainable living from trading.
He also emphasized aligning your backtesting with your real-world trading plan.
Okay.
He even suggested using 2 sets of backtests.
2 sets?
One with your full equity.
Okay.
And one with a smaller amount representing your paper trading capital.
So that way you can test your system under different risk scenarios.
Exactly.
And get a more realistic idea of how it might perform when you start trading live.
It's like having a dress rehearsal.
Yes, before the big performance.
And remember how we talked about using paper trading?
Yes.
To fine-tune your assumptions about slippage, stop-loss execution, and other variables that can impact your results.
It's all about bridging the gap between theory and practice.
Exactly. You can have the most beautiful backtest in the world.
Right.
But if it doesn't translate to real-world trading, it's not going to do you much good.
And he also suggested exploring more sophisticated stop-loss techniques.
Like a pick.
Things like volatility-based stops.
Volatility-based stops.
Rather than just a fixed percentage.
So instead of having a static stop-loss that stays the same no matter what, your stop adjusts based on the specific stock's price movements.
Exactly. This can potentially help you reduce losses during periods of high volatility when prices are bouncing all over the place.
That makes sense. And he introduced a concept I hadn't really considered before.
What's that?
Ongoing risk.
Ongoing risk.
So not just the initial risk you take when you enter a trade,
but
how that risk might change as the trade progresses and the market moves.
It's a more dynamic way of thinking about risk management.
I like that.
It's not just a one-time calculation, it's an ongoing assessment.
And finally, he touched on the idea of dynamic position sizing.
Dynamic position sizing.
Where your position size adjusts based on market favorability.
Interesting.
So you're taking bigger positions when the odds are in your favor and smaller positions when the market is more uncertain.
It's about maximizing gains during favorable periods.
Yeah.
While minimizing risk during uncertain times.
So we've covered a lot of ground in this deep dive. We've explored the instructor's insights on avoiding common mistakes in strategy development, data analysis, backtesting, market analysis, and money management. And we've delved into his concepts of mistakes and mastery, recognizing that mistakes are part of the journey and that achieving trading proficiency is an ongoing process.
He's given us a lot to think about, both in terms of the technical aspects of building a trading system and the psychological aspects of becoming a successful trader.
You know, he briefly mentioned the idea of incorporating a blacklist of stocks into your system. This makes me wonder, could you apply a similar concept to market conditions?
Oh, that's an interesting thought. Could you create a blacklist of market environments or signals that have historically led to poor performance for your system? That's something worth exploring as you continue to refine your trading approach.
It's like taking the idea of risk management to a whole new level. We'd love to hear your thoughts on this. Have you encountered any of these mistakes in your own trading journey? What are your biggest takeaways from this deep dive? Share your aha moments with us. Until next time, happy trading, and may your systems be ever evolving.